The world is about to run out of silver, and almost no one will see it coming. Not because silver is rare, not because mines are collapsing, and not because the price is screaming shortage. It's coming because the way silver disappears doesn't look like a shortage at all. It looks like normal business. It looks like progress. It looks like technology working exactly as designed. And by the time most people realize what's happening, the silver won't be gone from the earth. It'll be gone from the market, locked into products, infrastructure, and long-term contracts that don't care what the price says. So the real question isn't whether silver will run out. The real question is who gets it and who doesn't. And by the end of this video, you're going to know something that will permanently change how you look at shortages, prices, and so-called abundant resources. Because silver doesn't disappear the way people expect. It disappears quietly. Let me start with something that sounds obvious, but almost no one actually thinks through. If silver were truly scarce, the price would already show it. That's the logic. That's what we're taught. Markets are supposed to reflect reality. Scarcity pushes prices up. Abundance pushes prices down. And yet silver has spent decades being treated like it's everywhere. Cheap, replaceable, plentiful. People talk about silver like it's an old metal with no future, something we've already figured out, something that can always be mined a little more if demand rises. But here's the first uncomfortable truth. Silver isn't disappearing because people are hoarding it. It's disappearing because people are using it. And once silver is used, most of the time, it never comes back. Gold gets locked away in vaults. Silver gets locked away inside things. Inside solar panels. Inside electronics. Inside vehicles. Inside greeds. Inside infrastructure that was never designed to be taken apart again. That distinction changes everything. Because hoarded metals can come back to the market. Consumed metals usually can't. And this is where the illusion begins. When people look at silver supply, they look at mine production. They look at annual output. They look at above ground estimates. And they conclude that there's plenty to go around. What they almost never look at is how silver actually exits the system. Silver doesn't leave the market in dramatic collapses. It leaves in thin layers, microns at a time, spread across billions of devices, panels, circuits, and components. And because each individual use looks small, the collective disappearance stays invisible. This is why silver shortages don't announce themselves, they sneak up. Now, before we go any further, I want to challenge you with a simple question. If silver is so abundant, why does nearly every advanced technology rely on it? Not copper, not aluminum, not substitutes. Silver. Solar panels use it because nothing conducts electricity better with the same reliability. Electronics use it because signal integrity matters at scale. Batteries are beginning to use it because chemistry has limits you can't negotiate with. Silver isn't chosen because it's fashionable. It's chosen because physics keeps saying yes when everything else says no. And that creates a problem because demand for silver isn't being driven by investors anymore. It's being driven by systems. Energy systems, transportation systems, digital systems, things that don't stop just because prices rise. Let me slow this down because this is where most people get it wrong. When demand for gold rises, the market reacts. People buy. People sell. Gold moves from weak hands to strong hands. It stays above ground. It stays visible. When demand for silver rises, something very different happens. It gets consumed. It gets embedded into products that are designed to last decades, but not designed to be recycled efficiently. Once that silver is inside a solar panel on a rooftop, it's not responding to price signals anymore. Once it's inside a vehicle or a data center or a power grid, it's effectively removed from circulation, and that means traditional market logic starts to break down. This is why silver can look cheap right up until it isn't available. Now, here's where things get uncomfortable. Most people assume that if silver demand rises, silver supply will rise with it. More demand equals more mining. More mining equals more silver. Problem solved, except that's not how silver mining works. Silver is not primarily mined because people want silver. It's mined as a byproduct. Most silver comes out of the ground alongside copper, lead, zinc, and other base metals. That means silver supply is tied to the economics of entirely different markets. If copper demand slows, silver production slows. If zinc demand stalls, silver stalls. If base metal projects get delayed, silver gets delayed with them. And no amount of silver price increase fixes that quickly. You can't flip a switch and mine more silver. New mines take years, often decades. And most silver production IS&T coming from mines that exist purely for silver in the first place. This creates a structural rigidity that almost no one talks about. Silver supply does not respond cleanly to silver demand, which means shortages don't resolve themselves the way people expect. They persist. Now here's the next question you should be asking. If silver is being consumed faster than it can be replaced, why hasn't the market panicked already? And the answer is simple, but deeply misleading. Because paper markets still function. Futures contracts, ETFs, derivatives, synthetic exposure. On paper, silver can be traded endlessly without a single ounce changing hands. And as long as that system functions, it creates the illusion of abundance. But paper silver doesn't power a grid. Paper silver doesn't build a battery. Paper silver doesn't conduct electricity. Only physical silver does. And this is where the disconnect begins. Because industries don't buy silver the way investors do. They don't wait for dips. They don't speculate on charts. They secure supply. They sign long-term contracts. They pre-allocate production. They lock in delivery years in advance. And when they do that, silver doesn't disappear in one big event. It vanishes from the open market quietly. Now let me show you how this actually plays out. Imagine you're a manufacturer that depends on silver. Solar panels, electronics, batteries, grid components, whatever it is, silver isn't optional for you. If you don't get silver, production stops. Do you wait for the spot price to tell you when there's a problem? Or do you secure supply before there is one? Of course you secure supply. And when enough industries start thinking this way at the same time, the available pool of silver shrinks without prices needing to explode because the metal is already spoken for. This is why silver shortages don't look like empty shelves. They look like longer delivery times. They look like rising premiums. They look like quiet changes in contract terms. They look boring until they aren't. And this brings us to the moment we're in right now. Because silver demand is no longer growing linearly, it's colliding. Energy, transition, electrification, data infrastructure, transportation, all silver intensive, all scaling at once, and none of them care about investor narratives. They care about supply certainty, which means silver is being treated less like a commodity and more like strategic infrastructure. And when materials cross that line, markets behave very differently. Let me pause here and say this clearly. This is not about panic. This is not about hype. And this is not about tomorrow's price. This is about structure. Because once you understand the structure, you stop asking the wrong questions. Instead of asking when will silver spike, you start asking when will access disappear. And those two things rarely happen at the same time. Most people don't lose because they're wrong. They lose because they're late. And silver is a textbook example of a market where being late doesn't feel late until it is. Now, stay with me because this is the part where the story shifts. Up to now, we've talked about demand and supply, consumption and production, mining and usage. But demand alone doesn't create real shortages. Control does. And to understand how silver is actually being locked up, we need to talk about how modern supply chains really work. Not the way they're described in headlines, but the way they operate in practice. Because the silver that disappears first is never the silver people are watching. It's the silver people assume will always be there. And once that assumption breaks, everything else follows. Let's keep going. Modern supply chains don't operate on spot prices. They operate on guarantees. If you're on a factory that produces millions of units a year, you don't wake up every morning and check the silver price to decide whether production continues. You don't gamble your entire operation on market volatility. You lock supply. That means contracts, long-term agreements, pre-purchased material, priority delivery clauses, penalties for non-delivery, all negotiated quietly, long before shortages become public. And this is where the silver problem stops being theoretical. Because once silver is locked into contracts, it doesn't matter what the spot price says. that silver is no longer available to anyone else. It doesn't matter if demand spikes. It doesn't matter if investors rush in. It doesn't matter if the price doubles. That silver's already gone. And here's the part that most people miss. When industries sense tightening supply, they don't reduce demand. They accelerate locking it up. If you think silver might be harder to get next year, you don't wait. You secure more now. You extend contracts. You build buffers. You stockpile quietly. And when multiple industries do this at the same time, shortages compound invisibly. This is why silver shortages don't start with empty vaults. They start with silence. Now let's talk about who has the strongest incentive to do this first. It's not investors, it's not speculators, and it's not retail buyers. It's manufacturers who cannot function without silver, energy companies that depend on it for generation, technology companies that depend on it for performance, automotive companies that depend on it for reliability and safety. For them, silver isn't an asset, it's a requirement, and requirements get secured before they get expensive. This is also why geopolitical behavior around resources matters far more than daily prices. Countries that understand this don't wait for markets to tell them what's scarce. They treat materials like silver as strategic inputs. They prioritize domestic access. They tighten exports. They secure refining capacity. They plan years ahead, not because they want to shock markets, but because they want certainty. And when certainty disappears, everyone else pays for it. Now, think about how this plays out globally. Silver production is spread across many countries, but refining and processing capacity is not evenly distributed. Neither is industrial demand that creates. If refining slows, raw silver backs up. If exports tighten, downstream users scramble. If contracts lock supply, open market liquidity dries up. And none of this requires a dramatic announcement. No headline needs to say silver shortage. The system simply becomes less flexible. Delivery times extend, premiums rise quietly, substitution attempts increase and fail, and by the time people realize what's happening, the silver isn't missing. It's already out. This is why price charts are such a poor early warning system. Prices react last. Before prices move, behavior changes. Before behavior changes, contracts change. Before contracts change, expectations change, and expectations are changing right now. You can see it in how industries talk about materials. You can see it in how governments frame supply chains. You can see it in how companies prioritize resilience over efficiency. Silver sits at the intersection of all of this. It's critical. It's difficult to substitute, and it's being consumed faster than it's being replaced. That combination doesn't create a crash. It creates a squeeze. And squeezes don't announce themselves. They tighten. Now, here's the part where you need to slow down and really think. When people imagine running out of something, they imagine zero. Zero supply, empty shelves, nothing left. That's not how modern shortages work. Modern shortages are about access. You don't need silver to disappear completely for it to stop functioning as a market. You only need enough of it to be unavailable to enough participants. If industries with the deepest pockets and longest time horizons secure supply first, everyone else is left competing for what remains. And competition doesn't look fair. It looks chaotic. Prices spike unevenly. Availability varies by region. Paper markets detach from physical reality and trusty roads. This is when people finally start asking the right question. Not, why is silver expensive? But why can't I get it? And by then, the system has already chosen winners and losers. So let's bring this all together. Silver is not disappearing because it's rare. It's disappearing because it's essential. It's not being hoarded. It's being consumed. It's not responding to price signals. It's responding to industrial necessity. And it's not vanishing in dramatic fashion. It's being quietly absorbed into the backbone of modern civilization. That's why most people won't see it coming. They're watching charts. They're waiting for headlines. They're looking for panic. But the real signal isn't noise. It's allocation. And once allocation shifts, markets don't reverse easily. Now you understand why silver shortages don't look like shortages. They look like stability until suddenly they don't. And now you have to ask yourself something important. Are you waiting for the price to explain what's happening? Or are you watching the structure that makes the price inevitable? Because markets don't reward people who react to outcomes. They reward people who understand mechanisms. Most people will wait for confirmation. A few will recognize the pattern, and the difference between those two groups is rarely timing. It's awareness. Once you see how silver actually disappears, you can't unsee it. And that changes how you see everything else. Not just silver, but scarcity itself